We don't have exact analyst consensus estimates in this specific release, but honestly, a 316% jump in order intake absolutely crushes any historical baseline you'd want to look at.
Oh, without a doubt.
Right. So total Q2 2026 revenue hit $937.7 million, which is up 42% year over year.
Mm.
Earnings per share came in at a GAAP net loss of 2 cents, but adjusted diluted EPS was 8 cents. And for the full fiscal year 2026, their guidance is now set at total revenue of $3.8 to $3.9 billion.
With adjusted EBITDA of between 720 and 740 million, right?
Exactly. And because we are looking strictly at the earnings release document right now, we don't even have the post-market stock reaction yet. But the sheer scale of the equipment backlog in these numbers tells a very clear story.
It really does. I mean, it totally redefines the scale of this company.
So for everyone listening, the mission for today's deep dive is analyzing INU Group's Q2 2026 earnings report.
Which is their very first report since their June 5th IPO, right?
Yes, exactly. So we're breaking this down for retail investors to see what exactly is driving this explosive top-line growth and, well, what's hiding in the margins. Because when you see equipment order intake jump 316% in a single quarter.
Hitting, what, $2.3 billion?
Yeah, $2.3 billion. You have to look for the macroeconomic catalyst there. And reading through management's commentary, the demand driver is just abundantly clear. It's the sheer energy appetite of the AI boom.
Yeah, it's AI and data centers all the way down. Because that $2.3 billion figure, just for one single quarter, actually exceeds INIO's entire full-year order intake for 2025.
That is just wild to think about.
Right. You do not see that kind of demand curve in heavy industrial manufacturing without a massive paradigm shift in the market. What's happening is that they're taking orders way faster than they can physically pour the steel and assemble the engines.
Right, which completely balloons the backlog.
Exactly. That dynamic pushed their equipment order backlog up 279% year over year, hitting a record $6.6 billion. Management even explicitly noted this gives them revenue visibility extending out to at least 2030.
Wow. So it's basically like if you think of AI as this massive high-speed bullet train being built in real time, everyone is usually focused on the tech companies. You know, the ones building the software and the chip.
The glamorous stuff, yeah.
Right, but INIO is basically out there frantically laying down the steel tracks in front of it because they're selling the picks and shovels in this AI gold rush.
Well, except the shovels are massive decentralized power plants.
Exactly. Because without the physical infrastructure, that train doesn't move an inch. The traditional centralized power grid just can't handle the energy demands of these new, massive data center campuses.
No, it's totally maxed out.
Right. And INIO's CEO, Dr. Olaf Berlin, actually validated this directly in the release. He cited the, quote, accelerating demand for reliable, flexible, and efficient energy solutions. They are quite literally bypassing the grid.
And this earnings release put some really concrete dimensions on that bypass, too. I mean, they just secured a landmark 1.1 gigawatt gas engine order.
Which is huge.
It is. It's for a single major data center campus.
Yeah.
To put 1.1 gigawatts into perspective for you, that is basically the output equivalent of a traditional nuclear reactor.
Wait, really? A nuclear reactor?
Yeah, but instead of a nuclear plant, INIO is providing that baseline power through a decentralized on-site fleet of gas engines.
That is incredible.
And on top of that, they announced a multi-year framework agreement with a company called Relco for roughly 1.25 gigawatts of gas engine capacity.
And that was an expansion of an older deal, right?
Yep, it extends on a previous 700-megawatt reservation. So existing customers are just doubling their commitments because the grid constraints are only getting tighter.
But the thing is that they aren't just selling natural gas engines for today's problems. There is this massive future-proofing element in the report that really caught my eye.
Oh, the hydrogen demonstration.
Yes. They completed an industry-first demonstration of 100% hydrogen backup power at the 3-megawatt scale. And, you know, the critical detail isn't just that the engine worked.
Right. It's who is in the room watching it work.
Exactly. They had technical experts from Microsoft, Google, and Data4 on site witnessing the live testing.
And the presence of those hyperscalers is really the whole ballgame here.
Right.
Because data centers have these massive, publicly stated net zero climate pledges.
Right.
But currently, you know, when the grid goes down, they rely on massive diesel generators, which are obviously super carbon intensive and dirty.
Or they use natural gas.
Right. But they want to reach zero carbon emissions by 2030 or 2035. And you just cannot run a gigawatt-scale data center on lithium-ion batteries for 48 hours.
Yeah, the footprint wouldn't even make sense.
The physics just don't work. So hydrogen combustion engines are basically the holy grail for green baseload and backup power. By proving this tech works at a commercial 3-megawatt scale, INIO is showing these tech giants that their hardware is a future-proof solution.
Okay, wait. Help me understand something on the financials, though, because having the right technology and explosive demand is great. But let's look at how that actually hits the income statement.
Sure.
Because INIO divides their business into two main segments, right? Equipment, which is the physical engines,
Yeah.
and services.
Correct.
So the equipment segment hit $569.3 million in revenue, which is up a massive 61%. But their profit margins actually went backward.
They did, yeah.
The equipment adjusted segment EBITDA margin dropped from 18.7% down to 13.8% this quarter. If you're manufacturing and selling 60% more heavy hardware, shouldn't it get cheaper to make each unit? Like, where are the economies of scale here?
It's a really good question, and it's a classic bottleneck scenario. This is exactly what institutional analysts look for when a manufacturer hits hypergrowth.
Okay.
INIO CFO, Dr. Dennis Schultz, addressed this directly. The company is currently executing a multi-year capacity expansion plan across the U.S. and Europe.
Right, because of the backlog.
Exactly. When you are suddenly handed a $6.6 billion backlog, you can't just ask your current factory shift to work a little faster. You have to undergo massive, painful capital expansion.
So breaking ground on new facilities, that sort of thing.
Yeah, new production lines, paying premium rates to expedite raw materials, hiring and training thousands of specialized workers. All of that overhead drags down your gross margins in the near term. You basically lose efficiency before you gain it.
Okay, so it's the financial growing pains of scaling production. I get that. But that makes their second business segment, the services side, completely vital then.
Oh, absolutely.
Because while the equipment side is absorbing all those expansion costs, the services revenue came in at $368.4 million, up 21%. And the profitability there is just night and day.
Yeah, the economic profile of the services segment is really what makes this whole business model viable. It operates at a really lush 29.8% adjusted EBITDA margin.
Wow, nearly 30%.
Right. And that revenue stream is built on spare parts, engine overhauls, and long-term service agreements.
So it's the classic razor and blades model.
Exactly.
You sell this massive multi-million-dollar gas engine at a lower margin to capture the data center's footprint. But that physical engine locks the customer into a 20 or 30-year, highly profitable contract for maintenance and parts.
Right. They literally can't swap the engine out without disrupting their entire campus operations.
So that 29.8% margin becomes highly visible recurring revenue.
Yep. It's the profit annuity that balances out the cyclical nature of selling heavy equipment. But this actually brings us to a huge contradiction in this Q2 report.
Oh, the GAAP net loss.
Yeah. We have massive top-line growth, a highly profitable services arm. Yet INIO posted a GAAP net loss of $16.9 million for the quarter.
Which is crazy when you think about it.
Right, especially since they had a $62.4 million profit a year ago.
Yeah, a near billion-dollar revenue quarter, yielding a net loss on the bottom line. But when you dig into the non-GAAP reconciliation tables, the reality and the sheer cost of becoming a public company are glaring.
Oh, they are painful to look at.
The biggest anchor pulling their net income into the red is this $81.2 million line item, and they classified it as, quote, IPO and public market readiness costs.
It is just a staggering figure for a single quarter, and the breakdown of that reveals where the cash actually went.
Right.
So a massive $61.5 million of that total was for a long-term incentive program 2023.
Which basically means bonuses, right?
Exactly. Executive and employee performance bonuses that were entirely contingent on successfully taking the company public. The second the IPO closed on June 5th, that massive compensation package vested.
And accounting rules say they have to recognize it immediately.
Yep, it hits the expense line this quarter.
Unbelievable. And beyond the bonuses, there's another $20.8 million line item dedicated entirely to implementing U.S. GAAP financial statements. I really think people underestimate what that means.
They absolutely do.
I mean, it cost them over $20 million just to translate their European private company accounting into regulated U.S. public market standards.
Think about the operational friction involved there, You aren't just hiring a Big Four accounting firm to glance over your books.
Right.
You're implementing massive new enterprise software systems. You're hiring teams of auditors to map out every single financial process, literally right down to who has software permissions to approve a purchase order for raw steel in some Austrian warehouse.
It's incredibly labor-intensive.
Very. and very expensive.
But as an investor, you kind of have to strip that noise out to see the real engine of the company, right?
Yeah.
Because if you back out those one-off IPO bonuses and the accounting transition costs, the underlying business is actually thriving.
Yeah, it really is.
They reported adjusted net income of $57.4 million, and the core business generated $172.3 million in adjusted EBITDA, which is a 20% year-over-year operational increase.
Which perfectly highlights the divide between statutory accounting, which measures every single cost, including one-time IPO events, and managerial accounting, which shows you the actual ongoing run rate of the business.
Right. But we also need to look at how that operating profit translates to actual cash. So let's talk about their cash conversion metric, because if you're holding the stock, how should you view their ability to generate free cash flow with all these massive expenses?
So INIO defines cash conversion as their adjusted EBITDA minus capital expenditures, all divided by that adjusted EBITDA.
Okay.
Essentially, it's just a measure of how much operating profit they actually get to keep in the bank
Yeah.
after paying to upgrade their factories.
Right, which they are doing a lot of right now.
A lot. Because they are aggressively spending to build out capacity in the U.S. and Austria to clear that $6.6 billion backlog, their capital expenditures are highly elevated.
Yeah, they burned through $94.1 million on property, plant, and equipment just in the first half of the year.
Exactly. So in the near term, cash conversion is going to be suppressed. Now, investors will typically forgive the non-cash portions of those IPO expenses, like the stock-based executive compensation, because that just dilutes equity rather than draining the actual bank account.
Right, it's paper money.
Yeah. But that $20 million spent on GAAP implementation, that was real cash out the door. Yep. And the market will absolutely expect those readiness costs to vanish in Q3.
And that actually ties directly into their balance sheet, because that cash flow isn't just a nice bonus, it's a vital lifeline for them right now.
Oh, for sure.
They ended the quarter with strong liquidity, about $1.039 billion in cash and cash equivalents, which is up significantly from the end of 2025, obviously largely thanks to the cash they raised in the IPO.
Right.
But they're also carrying $2.6 billion in long-term debt.
And that is a very heavy leverage profile. You're in a prolonged high-interest rate environment, servicing $2.6 billion in debt consumes a massive amount of operational cash.
Yeah, they paid almost $92 million just in pure interest expenses over the first 6 months of the year.
Exactly. And this is exactly why that 29.8% margin on their recurring services business is so critical. It provides that reliable baseline cash flow they need to service that debt, while the equipment side undergoes this costly expansion.
Now, speaking of costs and risks, diving into the forward-looking statements and risk disclosures, which, by the way, every investor should read, no matter how dry they seem, I found a pretty massive red flag.
Oh, the internal controls disclosure.
Yes. Most companies just list standard boilerplate risks, but INAO specifically disclosed the risk of their ability to, quote, remediate the material weaknesses we identified in our internal control over financial reporting.
Yeah, that's a big one.
So why is a newly public company citing material weaknesses in their accounting controls such an immediate flashing red light for institutional analysts?
Because of the Sarbanes-Oxley Act, or SOX.
Right.
When you list on a U.S. exchange, SOX requires executive management to legally certify that their internal financial systems are robust, accurate, and totally resistant to fraud.
Right, you have to sign your name on the dotted line.
Exactly. So when a company discloses a material weakness, they are formally admitting to the SEC that their internal infrastructure is flawed, to the point where a massive error in their financial reporting might not be caught in time.
Which is terrifying for an investor.
It is. Now, for a private European company suddenly thrust into the U.S. public markets, this isn't totally unheard of. They're basically still building the plane while flying it.
Which goes back to that $20.8 million GAAP implementation cost.
Yeah.
They're actively trying to fix it?
Yes. However, institutional trading algorithms and human analysts absolutely despise uncertainty. If Wall Street cannot 100% trust the underlying data feeding into their valuation models, they will just apply an automatic discount to the stock price.
So INIO has to prove they've fixed this accounting weakness in the coming quarters.
Or it will act as a permanent ceiling on their valuation no matter how many gigawatts of engines they sell.
Wow. And the execution risks extend far beyond just their accounting department, too. Because the disclosures also place heavy emphasis on highly specific geopolitical risks.
Well, yeah.
They called out ongoing tensions between the U.S. and China, China and Taiwan, the Russia-Ukraine conflict, and Iran.
And look, These aren't just macro talking points for them. These represent direct physical threats to that $6.6 billion backlog.
Because of the supply chain.
Exactly. Building a localized power plant requires a highly complex, globally integrated supply chain. These engines rely on specialized steel alloys, heavy casting components, and highly specific microcontrollers that often originate in Taiwan or mainland China.
Right.
So if geopolitical tensions in the South China Sea escalate into blockades or aggressive tariffs, INO's manufacturing lines in Austria and the U.S. could literally grind to a halt just waiting for a $5 sensor.
And if they can't acquire the subcomponents, they can't ship the engines.
And they can't recognize the revenue. Exactly.
There is also this fascinating, highly localized risk mentioned regarding their ability to, quote, retain tax residency in Germany.
Yeah, the corporate structure quirk.
Right, because INO operates as a Dutch NV company, which is a corporate structure often chosen for IPO flexibility in Europe. But their operational headquarters are actually in Munich, Germany.
And cross-border tax law is just incredibly complex.
Right.
The risk here involves the concept of the place of effective management. If the German tax authorities determine that the company is effectively run out of Munich, but Dutch law claims jurisdiction based on their incorporation status, INIO could find itself trapped in cross-border tax treaty disputes.
Which could lead to the loss of regional tax incentives.
Or worse, they could face double taxation on their dividends. It's a structural risk that could take a direct bite out of their future net income.
Okay, so synthesizing all of this, what does it actually mean for you as an investor? INIO clearly has the exact product the market is desperate for right now.
Right. The demand is de-risked.
But their success hinges entirely on flawless execution over the next 24 months. They have to navigate global supply chains, aggressively expand their heavy manufacturing capacity without totally destroying their profit margins, and rapidly get their internal accounting controls up to the rigorous standards of the U.S. public markets.
It really is the ultimate test of operational leverage. The variable here is management's ability to efficiently process that massive demand into free cash flow, all while servicing $2.6 billion in debt.
Which brings us back to the biggest macro takeaway from this entire report. We started by looking at a single company's balance sheet, but INIO's explosive numbers force us to ask a much broader question about the future of technology.
Absolutely.
I mean, if a single decentralized energy manufacturer is sitting on $6.6 billion of demand and is completely constrained by how fast they can build power plants for data centers, it really changes the AI narrative.
It does.
Are we rapidly approaching a reality where the explosive growth of artificial intelligence is no longer gated by the availability of NVIDIA silicon chips or data center compute power? Is it now entirely constrained by the global physical grid's sheer capacity to generate enough electricity?
It's a massive shift.
It's something you definitely have to consider when looking at any tech valuation right now. Well, that is all for today's analysis. Make sure to subscribe and follow the show to get your daily deep dive into the earnings reports shaping the markets.